Picture a notification on your phone. You know the one. A small badge on the banking app you've been meaning to check. A number that appears while you're doing something else, something ordinary. And for a moment, your stomach drops just a little. A message that says your account was below zero, that a transaction went through, that the bank covered it for you, and that the fee for that coverage has already been charged. $35. You didn't borrow money. You didn't apply for a loan. You didn't review a term sheet or agree to an interest rate or fill out a credit application. You bought something that cost a few dollars more than your balance, and by the time you looked at your phone, the bank had quietly extended you credit, processed the charge, and collected $35 for doing it. That part most people already know. The fee is not a secret. What almost nobody has ever stopped to calculate is what that fee actually represents. If the average overdraft transaction is $26, which is what the Consumer Financial Protection Bureau found when it examined millions of actual overdraft events, and you repay it within 3 days, which is how long the average overdraft stays outstanding, the fee you paid works out to an annual percentage rate of approximately 17,000%. Not 17%, not 1,700, 17,000. That is not a rhetorical flourish. It is the Consumer Financial Protection Bureau's own calculation, published in official research, based on the actual average transaction size and repayment timeline of real account holders across the country. And the reason that number has never appeared in your account agreement, on your bank's website, or in the disclosure you signed when you opened your checking account, is not an oversight. It is the result of a specific decision made by the banking industry, ratified by federal regulators, and then protected by an act of Congress as recently as the spring of 2025. So this is not a story about a fee. It is a story about who designed the system that charges it, how they engineered it to extract the maximum amount from the people with the least, what happened when the government finally tried to stop it, and what that vote in early 2025 means for every checking account holder in this country going forward. Because this story has a villain, and the villain is not you. Let's go back to the moment before the fee, the shame that arrives with the notification, that quiet, familiar drop in the stomach, the feeling that you should have been more careful, that responsible people don't do this. That feeling is not a side effect of the overdraft fee. It is the mechanism that makes the product work. It is what keeps you from asking the question this video is built around. Who decided that $35 was the right number? And how did they decide it? Here is what the structure actually looks like from the moment you open an account. You walk into a branch or apply online. The fee schedule is disclosed in the account agreement, a document that runs dozens of pages, written in a font size and legal register that communicates clearly that it is not meant to be read. You skim it, or you don't read it at all, because the bank knows you won't and has designed the agreement accordingly. You link a debit card, you start spending, and at some point, through a combination of timing, an auto pay you forgot about, a pending charge that hadn't cleared yet, or simply a stretch of a tight month, you go below zero. At that moment, the bank has an entirely free option available to it. It can decline the transaction. The card is swiped. The balance is insufficient. The machine says no. You are mildly inconvenienced. The transaction does not go through. No credit is extended. No fee is triggered. Problem solved, at zero cost to either party. Declining costs the bank nothing. It generates no revenue. And this is why the bank does not prefer it. Covering the transaction generates $35. So the bank covers it, not as a kindness, but as a product. A short-term credit extension, charged at a rate that would be illegal under almost any other consumer lending framework, triggered without your informed consent, on a transaction you may not have even intended to make. banking industry has a name for this product. It is called courtesy overdraft coverage. The word courtesy is doing a great deal of work in that phrase. What it is covering for is the absence of the word loan. Now for the part that should genuinely stop you cold. Because the fee is only half of what was happening inside the accounts of millions of American customers. The other half is what certain major banks were doing before the fee arrived. Imagine you start a Thursday morning with $200 in your checking account. Over the course of the day, you make 4 purchases. A coffee for $4, lunch for $11, gas for $18, and then in the evening, a grocery run for $195. Total spending, $228. You're $28 over your balance. One transaction caused the shortfall. Here is how a bank processing transactions in chronological order would handle that day. The 3 small purchases clear first. Your balance falls to $167 after the coffee, lunch, and gas. Then the $195 grocery charge arrives and triggers a single overdraft event. One fee, $35. Here is how multiple major American banks were actually processing those same transactions. They held all 4 charges until the end of the business day. Then they processed them in order of size, largest to smallest. The $195 grocery charge cleared first, immediately overdrawing the account. Then the $18 gas charge triggered a second overdraft. Then the $11 lunch triggered a third. Then the $4 coffee triggered a fourth. Same transactions, same balance, same day of spending. 4 overdraft fees instead of 1, $140 instead of $35. This was not an accounting glitch. Internal documents obtained through litigation showed the reordering sequence was tested, modeled, and deliberately optimized for revenue impact. Banks ran analysis on which processing order produced the most fee events per account per day. They selected the sequence that maximized fees. They applied it systematically, across millions of accounts, for years. Wells Fargo paid $203 million to settle a class action lawsuit over this practice. Bank of America settled for $410 million. TD Bank settled for $62 million. Regions Bank settled for $90 million. The litigation ran across nearly a decade and established through the discovery process that the reordering was intentional, its purpose was fee maximization, and that bank employees knew precisely what it was doing to their customers. And after the settlements, the industry continued. Because a $100 million settlement, paid once, while the underlying revenue continues at several billion dollars a year, is not a deterrent. It is a cost of doing business. A rounding error on the income statement of an institution generating $40 billion a quarter. The fine was smaller than the revenue it protected, so the industry paid the fine and kept the practice. And this is where the first objection comes up, because it's the most natural one at exactly this point in the story. The objection is, I just need to be more careful. If I tracked my balance, I wouldn't overdraft. This is true, and beside the point simultaneously. Transaction reordering was designed to produce multiple overdraft events from a day of spending that would have generated 0 fees under chronological processing. The customers paying the most in overdraft fees are not making catastrophically bad financial decisions. They are people with thin margins operating inside a system explicitly optimized to find and charge those margins. Careful people with thin balances still overdraft. The engineering was designed to find them when they do. By 2010, federal regulators had seen enough to act, at least on one piece of the architecture. The Federal Reserve issued a rule under Regulation E, requiring banks to obtain affirmative consent before enrolling customers in overdraft coverage for debit card and ATM transactions. Before the rule, customers were automatically enrolled. Overdraft coverage was the default. To exit it, you had to find the right page on the bank's website or spend time on hold asking to be removed from a program you probably didn't know you'd joined. Regulation E flipped that structure. Banks now needed customers to say yes, not just fail to say no. Actually, say yes. The intent was clear. Many customers, if asked plainly whether they wanted to pay a $35 fee on a $4 coffee in exchange for the coffee going through instead of being declined, would say no. The regulation was designed to let them say no by default, to put the burden of enrollment on the bank rather than the burden of escape on the customer. What it produced instead was a demonstration of what happens when a regulation creates a requirement without removing the incentive underneath it. Banks invested substantially in redesigning their enrollment processes. The goal was not to help customers understand what they were opting into. The goal was to maximize opt-in rates within the letter of the new requirement. Overdraft coverage was repackaged in marketing language as financial safety, as protection, as peace of mind. The fee schedule was present. The interest rate equivalent was not. Customers were asked, often at account opening, whether they wanted to be protected from embarrassing declined transactions. Many of them said yes, without understanding that yes meant consenting to a 17,000% APR lending product. The Consumer Financial Protection Bureau, when it studied these enrollment flows years later, found that customers most likely to have opted in under confusion were the same customers paying the largest number of overdraft fees annually. Regulation E created an opt-in requirement. It did not create an informed opt-in requirement. And the industry, with sufficient resources and sufficient incentive, found the gap and built a business inside it. Here is the disclosure that was never required, and why that matters more than anything else in this video. Under the Truth in Lending Act, a payday lender is required to tell you the annual percentage rate on a short-term loan. A credit card company must show you the APR on a revolving balance. A car dealership financing a purchase must disclose the APR on the loan. This requirement exists because Congress, at various points in history, decided that consumers making borrowing decisions deserve to know the cost of the credit they are taking on. The overdraft fee has never been subject to that requirement. The banking industry successfully argued against applying truth in lending disclosures to overdraft coverage on the grounds that overdraft coverage is a service, not a loan. The customer is not borrowing money. The bank is providing a courtesy. The fact that the courtesy involves extending credit that must be repaid at a cost that, if disclosed as a rate, would exceed the APR of a payday loan by a factor of 40 does not change the legal classification. That classification was not arrived at accidentally. It was argued for, lobbied for, and maintained across decades of regulatory and legislative activity by an industry that understood exactly what full disclosure would do to the product's appeal. You do not spend decades fighting against a disclosure requirement unless you have a very clear reason to keep the number hidden. The number was 17,000%. And it was kept hidden because anyone who saw it in plain language on their account agreement would immediately understand that no product worth buying carries that cost. Picture what that disclosure would actually look like. You open your banking app. Right next to the $35 overdraft charge, in the same font as your balance, a single line. Annual percentage rate, 17,000%. That number, visible in plain text on a standard account statement, would end this product overnight. Not because regulators forced it to end, but because no informed customer would voluntarily sign up for it. The product survives on invisibility, which is precisely why the industry spent decades ensuring that number never had to appear anywhere you would see it. In January 2025, the Consumer Financial Protection Bureau finalized a rule targeting the largest piece of this system. The rule applied to banks and credit unions with more than $10 billion in assets. the large institutions where overdraft fee revenue is most concentrated. For covered institutions, the rule would have capped the overdraft fee at $5. The CFPB's own analysis projected the rule would return approximately $5 billion a year to American consumers. $5 billion annually flowing back to checking account holders instead of appearing as fee revenue on bank earnings reports. The banking industry's response was immediate. The rule was characterized as regulatory overreach, as a threat to the availability of overdraft protection for the customers who need it most, as a product ban dressed in consumer protection language. Let's examine that framing directly. The product being protected charges a 17,000% APR to people who typically have under $100 in their checking account. The customers described as needing it most are the customers paying the most fees annually, roughly 8 to 9% of account holders who generate approximately 80% of all overdraft revenue, disproportionately younger, lower income, and members of Black and Latino households. And the argument being made is that capping the fee at $5, not eliminating it, not banning overdraft coverage, simply capping the fee at $5, would harm those customers by reducing their access to the protection they depend on. The protection being described is a $35 fee on a $26 transaction, repaid in 3 days, at 17,000% APR. In early 2025, Congress used the Congressional Review Act to overturn the CFPB's overdraft rule. The Congressional Review Act allows Congress to nullify a recent federal regulation with a simple majority vote and a presidential signature. No extended legislative debate, no committee markup. A resolution, a vote, a signature. President Trump signed the reversal in March 2025. Think of it this way. A safety agency spends 3 years documenting that a manufacturer is selling a product it knows causes harm, issues a rule capping the damage, and then learns that a legislative body voted to tear up the rule in a single afternoon, and simultaneously prohibited the agency from ever writing the same rule again. That is not a hypothetical analogy. That is the precise sequence of events in this case. The investigation, the finding, the rule, the reversal, and the prohibition. All of it documented. All of it public record. The $5 cap was gone. The $35 fee structure was preserved. And under the terms of the Congressional Review Act, the CFPB is now prohibited from issuing a substantially similar rule in the future without explicit congressional authorization. That last clause is the one the headlines largely missed. This was not simply a veto of a single regulation. It was a structural prohibition. The agency that documented the 17,000% APR, that ran the research, that built the regulatory case over years of data collection and analysis, is now legally barred from trying the same approach again. The door was not closed, it was bolted from the outside, and the key was handed to the institutions that spent the most lobbying against the rule. The banking industry's defense of overdraft fees rests on a particular image: the occasional, mild inconvenience, the moment of carelessness that the bank kindly covers, the reasonable fee for a reasonable service. The data does not support that image. The Consumer Financial Protection Bureau found that overdraft fees are not distributed evenly across account holders. They are deeply concentrated. Roughly 8 to 9% of account holders pay approximately 80% of all overdraft fees. These are the so-called heavy overdrafters, people who overdraft 10 or more times in a single year. They are disproportionately younger, lower income, and members of Black and Latino households. The people paying the most for this product are the people who can afford it least, and they are not paying it because they are careless with money. They are paying it because a tight margin, combined with transaction reordering, combined with opt-in engineering, combined with no APR disclosure, is a system designed to extract maximum revenue from minimum balance. The CFPB also found something that cuts against the industry's core argument. When banks reduce or eliminate overdraft fees, account holders do not flood into financial ruin from declined transactions. They adapt. Some switch to cash. Some monitor balances more closely. Some switch to banks that don't charge the fee. The catastrophic outcome the industry predicted, mass financial harm from declined debit card swipes, simply does not materialize. What does materialize for the banks is a revenue loss. That is the harm the industry is protecting against when it lobbies Congress. Not your declined coffee. Their fee income. Several large banks, Bank of America, Capital One, Citibank, voluntarily reduced or eliminated overdraft fees between 2021 and 2023 in anticipation of regulatory action. They did not collapse. Their account holder bases did not shrink. Customers, it turns out, prefer banks that don't charge them 17,000% APR on accidental small overdrafts. The market, when properly informed, works, which is precisely why so much effort was spent ensuring it never became properly informed. Let me deal with the two remaining objections that come up every time this gets raised, because they're reasonable and they deserve honest answers. The first is, my bank eliminated overdraft fees. Some did. Bank of America reduced its fee to $10 in 2022. Capital One and Citibank eliminated overdraft fees on checking accounts in the same period. These were voluntary changes made in anticipation of what the CFPB looked like it was about to require. They are real and meaningful for customers of those specific institutions. They also represent a fraction of the total market. The majority of overdraft fee revenue is still being generated at institutions that maintained the $35 structure, and the regulation that would have changed the industry-wide standard was reversed before it could take effect. What some banks did voluntarily in one regulatory environment does not describe what most banks are still doing systematically. The second is the quietest and the most expensive to believe. This is just how the system works, and there's nothing I can do about it. This stops you from taking the steps that are genuinely available right now, and those steps are real and significant. Here is what you can actually do inside this system while the system is still this way. Move your checking account to an institution that doesn't charge overdraft fees. Ally Bank, Chime, Capital One 360, and many credit unions have either eliminated overdraft fees or restructured coverage so that transactions simply decline when the balance runs out. The switching process takes roughly 20 minutes. The potential savings for a household that triggers even a handful of overdrafts a year can run several $100s annually. This is probably the highest hourly rate financial task available to you this month. If you stay at your current bank, call or go into the app and remove yourself from overdraft coverage for debit card transactions. Regulation E gives you that right. The bank is required to honor it. Your debit card will decline when you're out of funds. That is not a disaster. It is a free notification. The bank has a strong interest in your believing those two experiences are equivalent. They are not. Ask about overdraft protection links. Most banks will transfer funds from a linked savings account to cover a checking shortfall for either no fee or a flat fee well below $35. This is not marketed prominently by institutions profiting from the overdraft fee, but it is typically available on request and will prevent most accidental overdraft events before they become fee events. Set a low balance alert at a threshold above zero, $25 or $50, so you receive a notification when you still have a decision available, not after the fee has already landed. The overdraft notification arrives after the charge has been collected. The low balance alert arrives while you can still act. These are workarounds, effective ones, but they don't change the underlying architecture for the millions of account holders who don't yet know these options exist. who will continue overdrafting at $35 a fee at institutions now legally shielded from the regulation designed to change this. Step back and look at the larger pattern, because this is where the story matters beyond the fee itself. Almost every financial product that systematically extracts money from the people with the least follows the same blueprint. A mechanism that works best when you don't understand it. A disclosure framework with a specific carve-out that keeps the most important number, the rate, the true cost, the APR equivalent, from ever appearing in plain language where you'd notice it. A regulatory effort that stalls in the lobbying process or gets reversed through legislative action when it gets close enough to matter. And a framing that consistently, reliably, points the explanation at your behavior rather than the structure's engineering. You spent too much. You weren't careful enough. You should have watched your balance. This is what the shame narrative does. It keeps the question pointed inward, at your habits, your discipline, your character. It keeps the question from turning outward toward the institution, the lobbying expenditure, the congressional vote, the signed reversal in March 2025. Overdraft fees are not the only place this blueprint operates. The same architecture runs through the minimum payment formula on your credit card, which was lobbied into existence by card issuers in the 1980s, specifically to ensure balances never fully clear. Through retirement account fee structures that technically satisfy disclosure requirements, while remaining practically invisible to the account holders, paying them for decades. Through insurance products with surrender charges buried deep enough that most policyholders never find them until it's too late to exit without a loss. The financial system is not neutral. It has architects. It has a legislative history. It produces outcomes that are not random. They are the intended results of a series of decisions made by identifiable institutions with identifiable interests at identifiable moments in time, many of which are a matter of public record. That is not a conspiracy theory. It is a lobbying disclosure form. The people who build genuine financial security inside this structure are not the ones with the most willpower or the most discipline in an extraction system designed to exhaust both. They are the ones who understand the architecture well enough to root around it, who know which products transfer value to them and which products root it away, who read the mechanism, not just the advice column. That is what forensic finance actually means. Not habits, not hacks, not 12 ways to cut your spending this weekend. The systematic investigation of how money flows through this economy, who designed the channels, where the exits are, and what it took to close them. The overdraft notification sitting in your phone is a document. It tells you exactly how much a specific institution charged for a specific product on a specific day. Most people read it as a verdict on their financial character. Start reading it as evidence of someone else's engineering. And if you want to see the next mechanism in this system, the one operating on the other side of your paycheck, shaping what you owe before you ever decide how to spend, that breakdown is waiting for you in the next video, because once you know what to look for, you can't stop seeing the architecture.